In this lesson, we will go over several closing costs calculations related to a settlement statement. These calculations will give you a better understanding of how to complete a settlement statement. Let's start with the discussion on prorating loan interest at closing. Mortgage payments are typically paid in arrears or in the past. For example, a mortgage payment made on May 1st will be for the month of April. When it comes time to close on a property, the seller will still owe partial interest on their mortgage for the month in which the closing occurs, since they will not make the next mortgage payment. This will be written as a debit to the seller on the closing settlement statement. From the buyer's perspective, they will not make a mortgage payment until after one full month of ownership of the property. For example, if the buyer closes on March 15th, their first mortgage payment wouldn't be until May 1st. The May 1st mortgage payment will include principal and interest paid for the month of April, since the mortgage payment is paid in arrears. For this reason, the buyer is still responsible for paying interest on the loan for the remaining days in March after the closing occurs. This partial interest payment will also be marked as a debit towards the buyer on the settlement statement. Let's go over an example to clarify how this works. We'll assume a property closes on April 17th. The seller was supposed to pay April's interest as part of the mortgage payment due on May 1st. For that reason, the seller is responsible for paying interest on their mortgage from April 1st to the 17th, or 17 days. The 17 days of interest owed by the seller will be paid at closing and will be marked as a debit to the seller on the settlement statement. The buyer will not have their first mortgage payment until June 1st. The June 1st payment will include the interest owed for the month of May. But what about the last 13 days in April? At closing, the buyer will pay the interest for the last 13 days of April, which will be marked as a debit on the settlement statement. Before we go into specific examples on how to calculate prorated loan interest, we first must learn how to determine how much interest is paid per diem, or per day. To calculate the amount of interest paid per diem, we must use the following formula. Loan amount times interest rate divided by 360 days. It is important to note here that lenders use a 360-day calendar rather than a 365-day calendar. Let's go through a quick example using this formula. We'll assume the loan amount is $370,000 at an interest rate of 4.25%. First, we must multiply $370,000 by 0.0425, the interest rate expressed as a decimal, to get $15,725. This is the amount paid in interest on an annual basis. Next, we divide $15,725 by 360 days. Remember, lenders use a 360-day calendar to get $43.69 paid in interest each day. Now, let's go through an example that may occur at a closing. The closing date is set for August 12th. The buyer is obtaining a new mortgage for $260,000 at a 4.5% interest rate. The seller's existing mortgage has a loan balance of $92,000 at a 5.25% interest rate. As noted above, the buyer will owe partial interest for the remaining days in August after the closing occurs. So, how much interest does the buyer owe for the month of August? First, we determine the per diem interest payment. This equals $260,000 times 0.045, or $11,700 in annual interest. Then, we divide $11,700 by 360 days to get $32.50 in interest paid per diem. Next, we determine how many days of interest the buyer is responsible for. August has 31 days, and since the closing is set for August 12th, the buyer will be responsible for 31 days minus 12 days, which equals 19 days of interest. Next, we determine the total amount of interest due in August. For this, we simply multiply the per diem amount by the number of days, which equals $32.50 multiplied by 19 days to get $617.50. The buyer will be debited $617.50 on the settlement statement. On the other side of the transaction, the seller is also responsible for paying partial interest for the month of August. So, how much does the seller owe? Just like with the buyer, we first determine the per diem interest payment. This will equal the loan balance of $92,000 multiplied by 0.0525, which gets us $4,830 in annual interest. We then divide $4,830 by 360 days to get $13.42 in per diem interest. Next, we determine how many days of interest the seller is responsible for. The seller is responsible for the first 12 days of August, since they still own the property through the closing date. Finally, we determine the total amount of interest due in August by multiplying $13.42 by 12 days to get $161.04. The seller will be debited $161.04 on the settlement statement. Next, let's discuss prorating annual property taxes. Property taxes are due on specific dates each year. However, even if taxes are due on November 15th, for example, they count towards the current calendar year, January 1st to December 31st. Because of this, there will be times when the property taxes have not yet been paid by the closing date. In this case, the buyer will have to pay the full year's worth of taxes after closing, and therefore be reimbursed by the seller for the days leading up to and including the closing date. In other words, the buyer will receive a credit from the seller, and the seller will be debited their portion of the property taxes. On the other side, if the property taxes for the year were already paid prior to closing, the seller will be credited the amount paid in property taxes through the closing date, while the buyer will be debited the same amount. Let's go through an example to see how this works. The closing date is set for April 20th. However, the property taxes are not due until May 15th. The annual property taxes due are $3,200. Since the property taxes have not been paid by the closing date, the buyer will be responsible for paying the full year's taxes on May 15th. For this reason, the buyer must be reimbursed by the seller for the days between January 1st and the closing date. This is because the seller is still responsible for paying the property taxes while they own the property. Let's go through the steps to determine the amount credited to the buyer. First, we must calculate the amount of taxes paid per diem. To find this, you must take the annual tax bill and divide it by 365 days. This equals $3,200 divided by 365, or $8.7671 per diem. Next, we calculate the number of days starting with January 1st and ending at the closing date on April 20th. January has 31 days, February has 28 days, March has 31 days, and April has 20 days until the closing date. That's a total of 110 days. Finally, we multiply the number of days between January 1st and the closing date by the per diem amount. This equals 110 days multiplied by $8.7671, or $964.38. Since the taxes will be paid after the closing date, The buyer will receive a credit for $964.38 on the settlement statement. The seller will be debited the same amount. Let's go over one more example, this time assuming the taxes were paid prior to the closing date. The closing date is set for August 5th. The property taxes were paid on January 15th in the amount of $5,600. Since the property taxes have already been paid by the seller at the time of closing, the seller must be reimbursed by the buyer from the day after the closing date to the end of the year. To determine how much the seller will be reimbursed, we must first calculate the amount of taxes paid per diem. This equals $5,600 divided by 365 days, or $15.34 per diem. Next, we calculate the number of days from the closing date until the end of the year. August will have 26 days. September will have 30 days. October will have 31 days. November will have 30 days. And December will have 31 days. This gives us a total of 148 days. Finally, we multiply the number of days between the closing date and the end of the year by the per diem amount. This equals 148 days multiplied by $15.3425, or $2,270.69. The buyer will have to reimburse the seller in the amount of $2,270.69 for the days after closing, since they will be the owner of the property. The buyer will be debited $2,270.69 on the settlement statement, while the seller will receive a credit for the same amount. Next, let's go over how to prorate hazard insurance premiums. Prorating insurance is different from property taxes in that insurance premiums renew on the date the policy was issued, which is usually the closing date for the existing owner. For example, if a homeowner purchased their insurance policy on February 15th, the policy will end the following year on February 14th. Hazard insurance is always paid in advance and will be marked as a credit to the seller at closing. The seller must be reimbursed by the insurance company for the days after closing and until their policy renewal date. Let's go through an example. The closing date is set for October 12th. The seller pays $1,200 per year in hazard insurance, with an end date of January 15th. To determine how much the seller will be reimbursed by the insurance company, we must take the following steps. First, we calculate the amount of insurance paid per diem. This equals $1,200 divided by 365 days, which gives us $3.2877 per diem. Next, we calculate the number of prorated days beginning with the day after closing and ending with the last day of the policy. There are 19 days remaining in October. November has 30 days, December has 31 days, and January will have 15 days until the closing. This gives us a total of 95 days. Finally, we multiply the number of prorated days by the per diem amount. This equals 95 days multiplied by $3.2877, which gives us $312.33. The seller will be credited $312.33 on the settlement statement. In other words, the seller's insurance company will reimburse the seller $312.33 for the days they prepaid but no longer owned the property. Next, let's discuss how to prorate rental income. In income-producing properties, the rental income collected each month must be prorated between the buyer and seller at closing. Rental income is typically collected in advance for the upcoming month. When the rental property is sold, the seller gets to keep the portion of the rent through the closing date, but will credit the buyer for that portion of the monthly rent beyond the closing date. Rent for a residential property is typically collected once a month, which means The amount prorated is based on the number of days in the month. Let's go over an example to clarify this type of proration. We'll assume the closing date is October 18th, and the monthly rental income is $1,500. First, we determine the amount paid in rent per diem. This equals $1,500 divided by 31 days, since there are 31 days in the month of October, which gives us $48.3871 per diem. Next, we count the number of prorated days for rental income starting the day after closing and until the end of the month. This equals 31 days minus 18 days, which gives us 13 days. Finally, we multiply the rent per diem by the number of prorated days. This equals 13 days multiplied by $48.3871, or $629.03. This means the buyer will receive a credit for $629.03 at closing, while the seller will be debited the same amount. Next, we'll cover how to calculate transfer taxes, as this is another settlement statement line item that must be completed. The transfer tax is also known as a conveyance tax. It is commonly paid by the purchaser. However, this may be negotiated between the parties. In Georgia, the transfer tax is set at 10 cents per $100 of the taxable sales price. For example, if a property sells for $350,000, the transfer tax will equal $350,000 divided by 100, which equals $3,500, and then multiplied by 10 cents, which gives us $350 in transfer taxes. It is important to note that if the buyer assumes the seller's existing mortgage, that mortgage amount will be subtracted from the taxable sales price. For example, if a property sells for $250,000 and the buyer assumes the seller's existing $90,000 mortgage, the transfer tax will be applied to $160,000 rather than $250,000. Let's go over a few transfer tax examples. First, we'll assume the purchase price is $280,000 and the buyer is not assuming the seller's existing mortgage. To determine the amount paid in transfer taxes, we must use the following two steps. First, we divide the purchase price by $100. This equals $280,000 divided by $100, or $2,800. Second, we multiply $2,800 by 10 cents. This gives us a transfer tax amount of $280. In the next example, we'll calculate the transfer tax on a transaction that includes an assumed mortgage. The purchase price is set at $470,000, and the buyer will assume the seller's existing $120,000 mortgage. The first step we must take is to subtract the assumed mortgage from the purchase price. This equals $470,000 minus $120,000, or $350,000. Next, we divide the taxable sales price by $100, which is $350,000 divided by $100, or $3,500. Finally, we multiply $3,500 by 10 cents to get a transfer tax of $350. Next, we'll cover how to calculate the intangible tax on a transaction. This is the second tax that may be included on the settlement statement. An intangible tax is assessed on new loans used to purchase a property. This tax is typically paid by the buyer. However, like the transfer tax, this is negotiable between the parties. In Georgia, the intangible tax is equal to the new loan amount divided by $500 and then multiplied by $1.50. In other words, $1.50 per every $500 of the loan amount. For example, if a buyer obtains a $420,000 mortgage to purchase a $525,000 house, how much is paid for the intangible tax? To find this, we must first divide the loan amount by $500. Remember, the intangible tax is based on the loan amount, not the purchase price. $420,000 divided by $500 equals $840. Next, we multiply $840 by $1.50 to get an intangible tax of $1,260. Next, we'll cover how to calculate the total monthly loan payment. You can use the acronym PITI, Principal, Interest, Taxes, and Insurance, to remember the components of a monthly loan payment. We'll start by learning how to calculate the monthly principal and interest on a loan, which is the P and I of the acronym PITI. In order to determine the principal and interest on a fully amortized loan, you must have two numbers, the loan principal, the amount borrowed, and the factor, the dollar amount charged by lenders, depending on the interest rate for each $1,000 borrowed. The factor can be obtained from a chart provided by the lender, or it can be obtained by simply Googling for mortgage factor charts online. For example, the mortgage factor chart will show that the factor for a 30-year fully amortized loan at a 4% interest rate is 4.77, or the factor for a 15-year fully amortized loan at a 5.25% interest rate is 8.04. Let's go over how to calculate the monthly loan payment using the loan amount and the factor. We'll assume the loan amount is $575,000 at a 5.5% interest rate. The loan is fully amortizing with a 30-year term. The first step is to determine the factor. The chart will show us that the factor for a 30-year loan at 5.5% interest rate is 5.68. Next, we divide the loan amount by $1,000. This equals $575. Finally, we multiply 575 by the factor of 5.68. This gives us a total monthly principal and interest payment of $3,266. Next, we'll learn how to calculate the monthly taxes and insurance. These are the T and I in the acronym PITI. Taxes and insurance are paid on a yearly basis. However, the lender will require the borrower to continue paying these charges into an escrow account each month. For this reason, you have to determine the amount paid per month in taxes and insurance by simply dividing by 12 months. For example, if the annual property taxes amount to $6,500, how much is paid in taxes each month in escrow? To find this, we divide $6,500 by 12 months to get $541.67. In addition to PITI, some borrowers may be required to pay an additional mortgage insurance fee if they are obtaining an FHA loan or their loan-to-value ratio is too high. The mortgage insurance may be in the form of a private mortgage insurance, also known as PMI for conventional loans, or a mortgage insurance premium, also known as MIP for FHA-insured loans. PMI is paid on conventional loans with a loan-to-value ratio greater than 80%. The higher the LTV, the greater risk to the lender, which means they will charge a higher PMI fee. For example, if a buyer is purchasing a $620,000 house using a $570,400 loan, how much is paid each month in PMI if the lender applies a 0.68% PMI fee? To find this, we first multiply the loan amount by the PMI fee. This will give us the amount paid per year for the PMI fee. This equals $570,400 multiplied by 0.0068, which gives us an annual PMI fee of $3,878.72. Next, we divide 3,878.72 by 12 months to get a monthly PMI fee of $323.23. Unlike PMI, MIP requires an upfront fee, which may be rolled into the loan amount, plus a monthly insurance premium. The upfront premium is calculated as 1.75% of the loan amount, and the monthly assessment is currently 0.85% of the loan amount, as per FHA guidelines. For example, if a buyer obtains a $245,000 FHA insured loan, how much is paid in monthly MIP if the upfront fee is rolled into the loan amount? To determine this, we must first calculate the loan amount with the upfront assessment added in. This equals $245,000 multiplied by 0.0175, which gives us $4,287.50. Then, we add $245,000 to get a new loan balance of $249,287.50. Next, we calculate the annual MIP by multiplying $249,287.50 by 0.0085, which equals $2,118.94. Lastly, we divide $2,118.94 by 12 months to get a monthly MIP fee of $176.58. Finally, let's put it all together using the following example. A property is being purchased for $400,000. The buyer will obtain a 30-year conventional loan of $360,000 with an interest rate of 4.5%. The lender is assigning a PMI risk factor of 0.62%. The loan factor equals 5.06. The annual property taxes amount to $7,200, while the annual insurance premium is $1,400. Based on this scenario, what is the monthly loan payment? The first step is to determine the monthly principal and interest. As we discussed earlier, you determine this by taking the loan amount and dividing it by $1,000, and then multiplying by the loan factor. This equals $360,000 divided by 1,000, which is $360. $360 times the loan factor of 5.06 gives us a monthly principal and interest payment of $1,821.60. The second step is to determine the amount paid in taxes each month. This simply equals $7,200 divided by 12 months, or $600. The third step is to determine the amount paid in insurance each month. This equals $1,400 divided by 12 months, or $116.67. The fourth step is to determine the amount paid in PMI each month. As we discussed a moment ago, we first need to multiply the loan amount by the PMI risk factor to get the annual amount paid in PMI. This equals $360,000 times 0.0062, or $2,232. Then, we divide the annual PMI by 12 months to get a monthly PMI payment of $186. The last step is to add up the PITI and the PMI payment to determine the total monthly payment. The P&I equals $1,821.60. The monthly taxes equals $600. The monthly insurance equals $116.67. And the PMI payment is $186. When you combine these four numbers, you get a total monthly loan payment of $2,724.27. And there you have it. These are the various calculations you need to know to complete a settlement statement. In the next few lessons, we'll review several examples of completed settlement statements to show you how the numbers change depending on the type of financing used by the borrower. We'll also review an estimate net to seller form. That being said, let's go to the next lesson.